If you own more than one piece of real estate inside a single LLC, you need to pay very close attention to what I'm about to say. Right now, there's a dangerous piece of advice circulating throughout the real estate community. Investors are buying their second, third, or fourth rental property, and to save a few bucks on state filing fees and accounting, they're dumping all of those properties into the exact same LLC. It sounds efficient on paper. You have one corporate binder, one bank account, and one tax return. You may think you've built a protective wall around your portfolio, but you haven't. You've actually built an interconnected landmine. You see, putting multiple properties into a single LLC doesn't give you multiple shields. It just ties all of your assets together in the exact same room. If a tenant slips on an icy porch at property A or a deck collapses at property B, that lawsuit isn't confined to that one house. The plaintiff can reach straight through that single LLC and legally grab the equity in properties C, D, and E to satisfy the judgment. One major event at your smallest property can completely wipe out the wealth you built in all the others. The reality is that most real estate portfolios are built completely backwards. So in this episode, we are going to reveal the exact order to form your LLCs properly for a business structure that actually results in true limited liability protection for real estate. We're going to map out the precise order and the daily operation of the trust, the holding company, and the operating company. Because the absolute baseline rule of asset protection is simple. Risk and value should be separate. So let's map out how to fix it. Let's look at the underlying assumption that trips up almost every scaling investor. And that is, when you first start out, you're told, an LLC protects your personal assets from your business liabilities. That is true. If a tenant sues the LLC, they generally can't take your personal home or your personal savings account. But here is what those entry-level tutorials leave out. The LLC does absolutely nothing to protect its own assets from its own liabilities. Think about what that means for a real estate portfolio. Let's say you have 3 properties inside Apex Rentals LLC. Property 1 has $100,000 in equity. Property 2 has $150,000 in equity. And property 3 is a multifamily unit with $300,000 in equity. That's $550,000 of hard-earned combined equity sitting inside a single bucket. Now, imagine a severe electrical fire happens at property 1 due to an overlooked maintenance issue. Tenant seriously injured. The damages easily exceed the limits of your landlord insurance policy. So when that tenant sues Apex Rentals LLC, they aren't just suing for the value of property 1. They're suing the entity. And because the entity owns all 3 properties, the equity in property 2 and property 3 is fully exposed. You didn't protect your properties. You cross-contaminated them. The fundamental mistake here is believing that everything belongs in one place just because it's under the same line of business. But everything doesn't belong in one place. When you blend your assets into a single operating bucket, you're gambling your entire portfolio on the safety of your single most volatile property. To prevent this, we have to look past simple formation and understand structural design. We have to understand that ownership is not control. Why do so many investors build their businesses backwards? The standard blueprint tells you to just keep filing properties under your primary business name, running all the rent checks through one account, paying one property management bill. It's built for administrative convenience, not survival. But when real pressure arrives, when a trial attorney starts digging into your business, they don't just look at the deed. They look at your data. They look at your operational habits. Because behavior leaves patterns. And if a court looks at your books and sees that rent from property 3 is being used to pay the mortgage on property 1, or that security deposits are all commingled in one massive, messy checking account, they see a pattern of behavior. They see an entity being treated as a personal piggy bank or a single disorganized pot of gumbo. And if you haven't strictly separated the operations, a clever attorney will easily argue that your LLC is just an alter ego of yourself or a giant undivided liability risk. Then the veil gets pierced and your protection evaporates. The question you should be asking as you scale isn't, how do I buy another property? The question must be, how do I isolate the risk of this new property so it can never touch the value of my existing ones? Let's look at the exact 3-layered design that Mature Wealth uses to solve this permanently. To build a portfolio that survives a catastrophic event, you have to separate your wealth into distinct functional zones. Here's how we map out a real estate structure from the top down. Step 1, the trust. At the absolute top of your structure sits the trust. The trust doesn't manage properties, it doesn't sign leases with tenants, and it doesn't collect rent. The trust exists solely to establish ultimate ownership continuity. It holds the keys to the entire empire. It answers the critical long-term questions. Who ultimately owns this real estate wealth? What happens to these deeds if I become incapacitated tomorrow? How does this portfolio pass to my heirs without getting locked up in probate or torn apart by taxes? The trust gives your portfolio a permanent, unbreakable anchor. Step 2, the holding company, the vault. Directly beneath the trust sits your holding company. This is the dedicated LLC whose entire purpose is to own, never to operate. Your holding company doesn't interact with the public. It doesn't own the physical real estate directly. Instead, the holding company owns the 100% membership interest in your individual property LLCs. It acts as the central vault. If your portfolio generates surplus cash flow, that profit is swept up into the holding company vault, completely out of the reach of any liabilities occurring down at the property level. Because risk and value should be separate. Your accumulated equity stays insulated up top. And step 3, the operating companies. Now, look at the bottom layer. Instead of one single LLC holding all your properties, we build independent, subsidiary operating companies, often called silo LLCs, for each asset. Property 1 gets its own dedicated LLC, owned 100% by the holding company. Property 2 gets its own dedicated LLC, owned 100% by the holding company. And Property 3, you guessed it, gets its own dedicated LLC, owned 100% by the holding company. Each property sits in its own completely isolated room. They each have their own separate lease agreements and their own separate bank accounts. Now, let's replay that worst-case scenario. Catastrophic event happens at property 1. A lawsuit is filed. The plaintiff sues the specific LLC that owns property 1. But what do they find when they look inside that container? They find only the equity of property 1. They look to the left, Property 2 is walled off in a completely different LLC. They look to the right. Property 3 is walled off. They look up. The holding company is insulated because ownership is not controlled. The fire has been effectively contained to a single room. The rest of your real estate empire doesn't even feel the heat. This isn't just a strategy for U.S. real estate investors using domestic LLCs. Whether you're holding multifamily assets through a proprietary limited company in Australia, a commercial storefront through a limited in the UK, or residential portfolios across different states or provinces globally, the fundamental logic of risk isolation remains identical. The statutory entities change based on your local tax code and jurisdiction, but the universal laws of asset architecture do not change. If you mix operational risk with stored asset value under any flag, you're creating a point of catastrophic failure. Because at the end of the day, behavior leaves patterns everywhere, and courts worldwide look to see if you've actually respected the boundaries you put on paper. So can an LLC own another LLC? Not only can it, but if you're serious about building long-term generational wealth in real estate, it's the exact structural design you need to be moving toward. Stop viewing business formation as a simple chore of filing a single document with the state and paying a baseline fee, and start viewing it as an architectural blueprint. An LLC is a highly effective tool, but only when it's deployed inside a system that understands that risk and value must live separately. Structure determines what survives. So before you close on your next property or renew your current tenant leases this year, take a hard look at your current corporate map. Ask yourself if you've actually built a protective real estate empire, or if you've just tied all your hard-earned properties to the same anchor and crossed your fingers, hoping it never drops. And if you want more breakdown strategies on how to master your business architecture, hit the like button and subscribe right now. But before I let you go, I want to hear from you. What is the one thing you wish you knew about LLC structures before you went out and bought your very first investment property? Drop your answer in the comments below. And let's look at what the entry-level tutorials left out. And let's fix the foundation. So if this gave you a different way to think about your structure, then like the video and subscribe, because most of what's out there is focused on formation, not what actually holds under review. And if you're already operating a business, then there's a free resource in the description called the Structural Exposure Check. It's a simple way to see whether your business is actually separate or just documented that way. And remember, structure isn't what you file. It's what survives under pressure.